Welcome to Bloomberg ETF IQ. I'm Scarlett Fu. Katie Greifeld is off today. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. The rebound in U.S. stocks loses some momentum as tech mega caps get hit, weighing heavily on investors already worried about an economic slowdown. And with the exchange conference on the calendar next week, we speak to VettaFi's Todd Rosenbluth on what to expect. And with AI being a huge focus, we speak to Jon McNeill of DVX Ventures on investing in tech supercycles that disrupt our world. But first, as always, Eric Balchunas from Bloomberg Intelligence is with us, and he's looking at flows. What do we have, Eric?
Scarlett, the flows are interesting. So let me just prepare you for what you're about to see. The 21 billion here in the VU, when that chart comes up, you're going to see 21 billion. That is a lot because there's a rebalance going on in the S&P. So this is a more like 1 or 2. And then SPY a little of that too. So there's a little bit of noise here. But I will tell you that there's been a consistent investment into U.S. equities this whole year. If you extrapolate up till now for the rest of the year, we're on par to tie last year's record of flows. So I haven't really seen anybody like flipping out at all based on the market so far in the ETF world. I will say there is one thing. Look at Bill, SGov, and GLD. I mean, that's treasuries and gold. So that is a little bit of hedge buying. So I think that people are buying their equities as usual. They don't want to miss out on any dip that, has a rebound. But they do want a little hedge. I think that's what I'm seeing here. Let's look at the outflows. And IVV is also going to look weird because of the tax. So just ignore that. A little bit out of the equal weight, a little bit out of treasuries here, which you could say is somewhat bullish. A little bit out of LQD, but nothing to write home about. And so I want to really focus in on this idea of the persistent bid in ETFs. But let's broaden that out to Vanguard. Vanguard is the biggest asset manager, fund manager in the U.S. They have taken in money to the tune of $1.5 billion a day this year. That is a lot of money, right? If you extrapolate their quarter, they're going to end up around $87 billion. That's almost going to be like the second best quarter on record. So I call it the Vanguard put. The Trump put, the Fed put are not as reliable as they once were, but the Vanguard put is alive and well. And so rain or shine, Scarlett, these investors are just relentless, and they do provide a little bit of a buffer to the down days.
All right, good stuff, Eric. Thank you so much. Joining our conversation right now is Anita Rausch, Global Head of ETF Capital Markets at AllianceBernstein. Anita, great to see you.
Thanks for having me back.
So Eric mentioned how the Trump put is kind of fading. Scott Bessent, the new Treasury Secretary, making clear that he's not worried about the market's recent downturn. And also, Jay Powell is preferring to kind of stand back and wait to see what happens. So the Fed put is also not really there. Do you buy this idea of a Vanguard put, this visible support from retail buy and hold traders, investors?
Well, yeah, whatever you call it, I mean, people are out there still making money, right? We still have money to invest on a regular basis, and most of us are long-term holders. So there's always going to be some sort of money going into the market, whether it be in passive, active, or even in the hedging space, which we're seeing a lot of.
Yeah, someone wanted me to rename it the boomer put to broaden it out to the 401k world, because there was an article in the Wall Street Journal earlier talking about 0.4% of 401ks registered anybody moving money. And I actually checked with Vanguard, and they found that there wasn't one day this year where there was more sellers than buyers in terms of U.S. equities for them. I just think it's like Pavlovian dogs. Every single dip there's been, if you pulled your money out, you regretted it. So every dip has been bought and you benefited, so therefore dip, I buy. I just don't see how we get out of this.
Well, here's the thing. I mean, through the years and all the cycles, I think it's proven that you can't really time the markets, right? So the best thing that you can do, and I think it's been mathematically proven, is just to stay in. And when things go on sale, you see the natural reaction, just like you said, Pavlovian's dog, right, to just go and add more.
What do you look for, Anita, in ETF flows to help determine whether the stock market has found a bottom for now?
ETF, well, you know what? I wouldn't look at the broad set of ETF flows and whether the stock market has found a bottom, because there's an ETF for everything, right? If you think the stock market's going down, there's an ETF for that. If you want to hedge yourself, there's an ETF for that. If you want to go long and super risk it up and leverage it, there's an ETF for that as well. But something that we've really been seeing, especially at AB, is a lot of money going into the buffer space. And I know, Eric, you love that space. But yeah, I know you do. As volatility increases, we're seeing a range of clients, retail to institutional clients, really say, okay, I want to be in there. But I kind of want to minimize my downside, and I'll risk some upside for that.
Yeah.
What do you call it?
We call it boomer candy.
Yeah, there you
because
go.
it just fits their psyche. Think about it. You made all this money in the market over 35 or 50 years, really, and you're just scared to lose it. And in 2022, bonds went down as much as stocks. So your 40 didn't protect your 60, and you're seeking protection. So these things use options to minimize your downturn or eliminate all of it, but you give up upside.
Right?
Yeah, but they seem to be willing to do that.
Yeah.
I just feel like they want to walk around their daily lives, their retirement, with peace of mind. So to me, it's sort of like a...
This gets them there.
Yeah.
There's something to be said for a little amount of certainty, right? People are willing to pay for that.
Do you consider buffer ETFs active funds?
They are. Yes.
So when people plow into active ETFs, how much of that do you think is buffer funds?
Oh, listen, I think a buffer is definitely a small but very growing segment. Buffers has only been around 6 to 7 years, right? It's become extremely popular, and I think punching above its weight for sure, considering the amount of time that it's been around. But I think, like I said, people are really using it to gain the amount of certainty that they need in the volatile times right now.
And I'm looking at your funds. Year-to-date flows, your buffers are in the top 3, but the number 2 is totally different. It's the Disruptors ETF.
Right.
This sort of Archean kind of, techie stock picking ETF. I'm a little surprised by that. What do you make of that in a year like 2025?
Listen, I think it's still ups and downs like we were just talking about. Things go down. Oh, it's on sale. I want to buy it. But this is a popular space. Tech, AI, it's constantly in the headlines. People are using the likes of Forward, FWD as a sleeve to gain exposure to momentum.
We see a lot of people flocking to overseas markets right now. The U.S. stock market has been underperforming Europe. It's underperforming Asia, emerging markets as well. The increase in overseas ETFs, other countries' ETFs, is that mainly for that domestic market or for U.S. investors?
Well, no, U.S. investors actually can't invest in overseas market, but the local listed ETF markets around the globe are growing incredibly. And from a percentage perspective, much more than the U.S. The U.S. is not maturing, it's still growing, but I think Europe had its best inflow of active ETFs last year, so just passive and active. And then the numbers out of Asia are actually stunning from an ETF growth perspective. They're really taking hold of this ETF concept and using it from retail to institutional, both active and passive, and there's a lot going on globally in the ETF space.
And the central banks. The China national team just bought like $70 billion worth of ETFs.
Japan is another big buyer.
Well, Japan owns most of the...
Yeah, it is. It's an interesting scene over there. And in South Korea, they love the leverage.
Oh, yeah.
It's just the whole...
U.S. issuers made products for them, right?
Yeah.
Absolutely.
And just real quick, AB, just looking forward, you guys have moved a lot of your mutual fund managers and gotten them ETFs. What's the move forward? Is it just to sort of get all of them into the ETF format? What else you got?
Well, no, I mean, we've added ETFs to the roster of what we have and what we can launch. And so when we come up against any new strategy, we look at it and say, where will it best serve our customers? Is it going to be in a mutual fund? Is it going to be in an SMA? Or is it going to be in an ETF? ETFs obviously have a lot of advantages. And so now, a lot of the times, the ETF is the answer.
Yeah.
But now it's just part of our offering because that's what the investors were really demanding. They wanted that flexibility.
Anita Rausch of AllianceBernstein, thank you so much for joining us today.
Thanks for having me.
Great seeing you. Coming up on ETF IQ, we look ahead to the Exchange Conference in Las Vegas. Todd Rosenbluth, a friend of the show, he's a VettaFi, will be joining us next. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Scarlett Fu. It's time now for the ETF Brief, where we highlight stories and trends that caught my eye. Now, an upstart stock exchange based in Texas poaching talent as it prepares to push into the ETF universe. Cboe Global Markets' former head of ETP listings, Rob Morocco, will be joining the Texas Stock Exchange as its global head of ETP listings, while NASDAQ's former head of ETP listings, Allison Hennessy, will become its new managing director of ETPs. Let's also talk about U.S. spot Bitcoin ETFs. They have seen record outflows to the tune of $5.3 billion since February 10th. Assets have now dropped to about $93 billion from a peak of $123 billion at the end of January, mirroring the slide that we've seen in Bitcoin's price to below 85,000. Now, according to Bloomberg Intelligence, hedge funds likely helped drive the outflows as the profitability of the Bitcoin basis trade shrank. And let's end things on PRIV, the first ever private credit ETF that State Street launched in partnership with Apollo. Katie and I spoke exclusively to State Street's Anna Paglia on the firm's dialogue with the SEC before and after PRIV began trading. Take a listen.
We thought the process had concluded. It had not. We got the new comments, and we answered those comments within 24 hours. So in the last couple of weeks, I think that more drama than was warranted was created in the market.
Anna Paglia there of State Street. Now, meantime, next week is the annual exchange conference where it's all things ETFs. So, of course, we needed to bring in Todd Rosenbluth, head of research at VettaFi. Todd, before we get to some of the things that are going to be showing up at exchange, I want to get your thoughts on PRIV and how much of a talking point you think that's going to be, given that the SEC was involved. It sent that letter, which is not a normal course of action for the launches of ETFs.
Well, I think private credit is going to be a hot topic for us at exchange. We're going to be talking about it on stage with Bond Blocks. They have a different private credit CLO ETF, but this is going to be one of the buzzwords. And we're also hearing from advisors. We had a recent virtual event, and private credit was one of those investment styles we asked advisors, are they interested in? And about 20% of that advisor community that we were talking to wanted to learn more about private credit ETFs. So I don't think the flows are that strong out of the gate. But we're a week or 2 weeks in to an ETF's history. It usually takes a little bit longer for many ETFs to get up to speed.
Especially for fixed income. If it were private equity, I think it would have more of a splash effect. XOVR is one that actually added in some private equity. So it had, I think it has a 10% in SpaceX. And as soon as it added it, the flows really, it was a fund that changed strategies. Once it did this, the flows came in. It's now got 300 million in assets. Do you think that the advisor demand for private equity and credit is simply access, that they just like the ETF wrapper and that's how they want to get everything delivered to them? Or because they can't really get it outside of that, right?
They can't. So the ETF gives you the access to many investment styles. I do think we're going to see more private equity related strategies, private credit related strategies. Crane Shares made some news about a week or so ago by adding a private equity stock to one of their ETFs. It's still going to build a following, but I think that's a sign of the times and also one of the areas we're going to focus on at the conference, the future of ETFs.
How important is first mover advantage when it comes to these private assets? I mean, I've noticed that BlackRock isn't necessarily here, but usually when BlackRock comes is when the bulk of the money follows.
Well, I think getting early and creating and educating helps. But then when that often happens with somebody outside of the big three. This time it's happening or close to happening with State Street. They are certainly the original ETF provider. But we usually see innovation happening at some of the smaller providers, and then we see others. BlackRock, for example, launched a managed futures ETF about a week or so ago. We've had managed futures ETFs from some other firms that are out there, but BlackRock will certainly add some legitimacy to that space for many investors.
All right, let's talk about the conference. This might be, it's sort of my 15th straight year going. That's how old I'm getting, Scarlett.
How many years has this been running?
I think since like 2005-ish. So I got in there 2010.
Okay, you're one of the OGs.
When I got there, I'm like, this is it. This is the future. I remember the band was a U2 cover band, and it was an ice cream social. Meanwhile, my friends in the hedge fund space were going to SALT and hearing like Obama speak and stuff. And I always thought that was interesting. The ETFs, just a little less money going around in that industry. But I want to ask you about the reason I liked it was a conference put on by analysts. The material and the content was so good. You're now carrying the torch. It used to be called Inside ETFs. It's now Exchange. And the big difference this year, it used to be in Florida. It's in Vegas for the first time. What's that about, and what can we expect?
So we're so excited for the conference. We've got over 1,800 people who are pre-registered for it as of this weekend. 850 of those are financial advisors with valid CRDs. So this is an exchange conference about ETFs, but geared towards advisors. So I think one of the things that advisors are going to get at it is hearing from their peers. We have some of your colleagues are going to be doing interviews on stage with ETF strategists. Emily and Katie are going to be doing that. We've got asset managers that are going to be on stage. Eric is doing a session on all things surprising at Bitcoin. Can you believe he wants to talk about Bitcoin in front of an audience?
He loves it.
Does this on a weekly basis. I'm going to be talking about fixed income with some of our partners at FM and Bond Blocks. We're going to cover a wide range of topics. And what we're doing, I know we're talking about ETFs, and this is an ETF show, but we have a practice management track as well for advisors that want to be better at being advisors. So should they outsource their CIO efforts? How do they plan for retirement with their clients that are very young? We're covering a wide range of topics.
So everything about the ETF wrapper and the ETF ecosystem, for that matter. Todd, really appreciate you joining us. Thank you so much. Todd Rosenbluth of VettaFi, and of course you can see him at the Exchange Conference next week. Now, still ahead, we speak to Jon McNeill of DVX Ventures on funds targeting AI and investing in Supercycles. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu. It's time now for today's drill down, where we focus on one ETF. Eric?
Scarlett, today we're looking at an AI ETF, thematic. So this is the VistaShares Artificial Intelligence Supercycle ETF. AIS is the ticker. It's going to look through stocks to try to pick out ones that are involved in the AI space. This is a hot theme. There's about 12, 13 ETFs on the market that do this, and they've got about $7 billion. So it's one of the bigger themes. It's actively managed. Yes, and it's 75 basis points, and it's about 3-4 months old, and the market cap is 7 million. So it's still pretty small. It's a newbie, pretty much. So it's going to have to perform probably to get some assets. Let's look at what it holds. And I went into the sector breakdown. It's a lot of infotech, almost 88%. That kind of makes it somewhat different. It's got a lot of active share versus the S&P, of course. Most theme ETFs do. It's got a lot of active share versus AIQ, which is the biggest AI robotics ETF from Global X. And this one's going to have more international and a little more small cap than the Global X. Let's look at the performance of this one, AIS, versus AIQ. I also threw in chat, that's the Roundhill one, and the S&P. You can see it's only a couple months, so it's a lot of noise in here, but you see these numbers here. The AIQ doing a little better, could be because of that international or lack of small cap, but those things, it's just all going to play out how it plays out. I think, Scarlett, over the next year or two, if it can get a performance breakout, that should definitely help it get some looks.
Absolutely. Performance always does that, right? Eric, thank you so much. And joining us now to talk about this ETF is Jon McNeill. Jon is co-founder and CEO of DVX Ventures, and he's the former president of Tesla. Jon, as always, it's a pleasure speaking with you. Eric mentioned the name of the fund, and the word supercycle is in there. Artificial Intelligence Supercycle ETF. What is a supercycle versus a conventional market cycle?
I think, it's basically we as investors see major cycles, maybe once a career, like the Industrial Revolution, the Internet Revolution. And right now, as investors, we've got 4 or 5 happening simultaneously, where you're seeing major sectors really be invented and grow from nothing to substantial. We've got AI happening now. We've got electrification. We've got robotics. We've got space. And we've got biotech all happening right now. So what we decided to do was dive into each one of these deeply and understand not at a high level which stocks to follow, but really what the build sheet was for instance, an AI data center, which is why, as Eric pointed out, you see a lot of international and infotech stocks, because it turns out that NVIDIA is single digits of an AI data center in terms of its representation. But you've got a lot of networking software, you've got a lot of fiber optic software, and you've got a lot of connectivity between all of these chips that are powering these AI data centers. So when we went in and looked at the build sheet of an AI data center, what we found was over 60 public stocks, roughly half US, half international. And what we wanted to do was give investors exposure to the full stack of the AI infrastructure, not just kind of the headline stocks.
Yeah, and that brings up a good point. When you look at thematic ETFs, they have what I call M&A pop, especially if the smaller names have a decent weighting. If they get acquired, they can go up a lot in no time. Are you looking to include some of those possible M&A targets in here?
That's a great point. We're not actively looking at M&A targets, but these companies are going to naturally become M&A targets. And it's just one of the reasons we're actively managed, Eric, is because of this dynamic where you see big changes in the technology from quarter to quarter and sometimes within a quarter. And so, for instance, an AI data center has 4 times the fiber optic cable that a regular data center has. So that puts like old line stocks like Corning into play. Very large cap, but one that isn't in the AI conversation a lot unless you're deep into the problem. What we're seeing now with new AI data centers is networking hardware and software as a percentage of the total rack spend is projected to go, we think, from 10% to 50% of an AI data center. And just as you point out, that's naturally going to create M&A targets as some of these stocks become more visible to a wider pool of investors.
So M&A news would certainly be a good news story for a lot of these companies. What about tariffs? That can be seen as a bad news story here. And of course, there's a lot of questions about the resiliency of supply chains, the flexibility of these companies in light of all these tariff threats, these on-off tariff threats.
Yeah, it's a great point. I think one of the things I try to keep in mind, Scarlett, is that the United States isn't the only place where data centers are being built for AI. They're being built all over the world, and especially in Asia. So you've got a complex marketplace to look at as these tariffs potentially come in. But we don't look at it just from a U.S. eye. We look at it from an international eye and really focus on, okay, how will this affect the Asian data center builds? How will this affect the European data center builds? The Middle Eastern data center builds, which are becoming more and more part of the equation. And that's part of the active management layer that we're putting on, is being able to respond to not only U.S. dynamics, but international dynamics.
Jon, about 30 seconds left here. You're not your average ETF issuer. You were executive at Tesla and Lyft. And what drew you to the ETF world?
Guilty as charged, Eric. I'm not. I think what drew me in was, as people started to ask me about the electrification supercycle, I started to look into these ETFs. And what I found was the #1 EV ETF, electric vehicle ETF, its top 5 holdings were things like Apple, Microsoft, Google, and NVIDIA. There's no NVIDIA chip in a car. There's no real Apple revenue in a car, Google revenue in a car. What I found was those EV supercycle ETFs looked a lot like the S&P 500 at a much higher price point. And what we wanted to do was dive into the build sheet of an EV and bring those 65 public stocks to bear so that you'd get a pure exposure as an investor versus just a repeat of the S&P 500.
Spoken like a true industry insider. Jon McNeill, really appreciate your joining us. Jon is DVX Ventures president and co-founder. Now, you can read more about this drill down plus the latest in the ETF industry when you subscribe to our weekly ETF IQ newsletter.